vibration that led success so high. I will achieve, I will fly high. I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
When the government announced the transfer of control of IDBI Bank to the Life Insurance Corporation, not many had considered it privatization, but just a changing of hands within the government. Since then, it has made concerted efforts to privatize the bank. Media reports suggest the centre may approach TPG Capital, Carlyle Group, and Fairfax Holdings for IDBI Bank. Success shall set the template for future privatization of other public sector banks. Good morning, my name is Ishan Gera and you're watching the Business Standard Banking Show. In today's episode, we'll discuss the week's important developments, including RBI's discussion paper on payments. We have an interview lined up with Sanjiv Chadha, MD and CEO of Bank of Baroda. In our Banking for You section, experts explain what the merchant discount rate is, and our banking expert Tamal Bandyopadhyay discusses the P2P lending model in India, its failures, and his take on the MDR issue. At the end of our show, we shall discuss the results of our last poll and ask you a question for our next poll. So stay tuned. But first, a look at the banking developments of the week. Last week, the central bank released a paper on charges in the payment systems for public feedback. The Reserve Bank mooted the idea of tiered charges on UPI payments, regulating the levy of convenience fees and surcharges, and the issue of merchant discount rates. RBI also wanted to understand if RuPay can be treated differently from other debit cards. Currently, MDR for RuPay debit cards is 0. NPCI has been contemplating charging MDR on RuPay credit cards linked to UPI. However, the government has clarified that there is no move to levy a fee on UPI transactions, as UPI is a digital public good. The issue will need to be resolved faster though, as the promotion of UPI will be predicated on banks' incentives. Another issue that required clarification, and this time from the central bank, was the privatization of PSBs. Although the government is gung-ho on privatization, it is unclear on the best way forward. In an article that does not reflect the central bank's views, RBI's researchers had written that a big bang approach would do more harm than good. They highlighted that the government needs to ensure large-scale privatization does not create a void in fulfilling important social objectives of financial inclusion and monetary transmission. Batting for a gradual approach, they also said that this sector was stronger after consolidation. Meanwhile, another one of RBI's decision is altering the financial landscape. 1. The rise in rates has not dented credit growth. 2. Banks' transmission of rates in savings schemes has increased as they weave for more deposits. After RBI announced another rate hike of 50 basis points a fortnight ago, the banks have raised FD rates. IDBI offers an interest rate of 5.8% for fixed deposits over 5 years, and HDFC is offering 6.1% for a 5 to 10 year term limit. It is not just the banks which have experienced an increase in credit offtake. Results show that credit offtake from NBFCs also jumped in the first quarter of 2022-23. In a paper published in RBI Bulletin, researchers highlighted that the sector's bottom line had been consistently improving, but risks remain, especially due to rising rates. RBI's FSR report has been warning of risks to the sector. In the last 2 years, public sector banks have outperformed private sector ones in terms of net profits. Business Standards Banking editor Manojit Saha interviewed Sanjiv Chadha, MD and CEO of Bank of Baroda, to discuss the bank's growth and future outlook.
Welcome to the Business Standard Banking Show. Credit growth has returned to the banking system this financial year after a gap of 2 years. Year-on-year credit growth was 14.5% as on July end, as compared to 6.1% in the previous year. Deposits, however, growing at a slightly slower pace at 9.1%. Banks have reported healthy profit in the first quarter, but faced mark-to-market losses on their bond portfolio due to rising yields. To talk more about the growth opportunities and the challenges faced by the banking sector and also Bank of Baroda in particular, we today have Sanjiv Chadha, MD and CEO of Bank of Baroda. Mr. Chadha, welcome to the show.
Thank you, Manojit.
So, sir, Bank of Baroda has reported 18% growth in global advances in the first quarter, which was a bit higher than the industry. Do you see the trend still continuing in the second quarter itself?
So I think there are two parts to the answer. One is that, as you very correctly said in your opening remarks, we are seeing some strengthening in terms of the growth trend. So the growth is likely to be better as compared to the last year. But it's also equally important to bear in mind that the first quarter last year was unnaturally depressed because of the second wave for the industry and particularly for us. So I think there may be some moderation that we might see as far as the growth is concerned, but nevertheless, it should be significantly better as compared to last year.
Right. So the growth is coming both from the corporate sector as well as retail sector, isn't it?
Absolutely. So I think we had seen consistent growth from retail even last year. It was fairly resilient. When it came to corporate, I think we are seeing an improvement there. Equally, I think when it comes to the corporate sector, because the liquidity was surplus, a lot of demand again got diverted from the banking sector, which again, as you talked about the fact that interest rates are rising, so that demand is coming back to the banking system. So the contribution of the banking system to growth and to financing should be more this year as compared to last year.
Right. Sir, but are you seeing demand for greenfield projects, sir, from the corporate sector?
So I think there's a change which has happened. Over the last few years, there's been a consolidation trend in the industry. And a lot of capacities have got concentrated among the stronger players. Now, and a lot of investment demand is actually coming from these stronger players. So therefore, while the demand is there, it is also very good quality demand. So my own sense is that even as we go forward and as capacity utilization improves, a large proportion of demand will come from the stronger players in the sector, which augurs well for the quality of credit that we put out.
Right. So coming to the retail credit part, you have seen good growth in the unsecured personal segment. Was that the intentional or as a one-off thing you see that happened in the first quarter?
So I think we have broadly seen a trend where for us, retail growth has been faster than corporate growth. And I think that's a trend which is likely to continue. If you look at a balance sheet, 50% is corporate. And I believe over a period of time, a correction of that little bit of bias is something which will be good for the bank. But coming to your specific question about unsecured personal loans, this was a category which was relatively small for us. And this is something which has become much more important for us after the digitalization initiatives that the bank took. You might recall that in August last year, we had launched BoB World. Now, within 1 year, BoB World has gathered something like 22 million customers. And therefore, it gives us access to our entire database, customer transactions, and it is possible to underwrite good quality unsecured loans. So since this category was relatively small, we see large growth. But I think even as we go forward, this should be a larger part of a balance sheet. But probably the growth rates will moderate since the earlier growth was on a smaller base.
So overall growth, what kind of credit growth you are projecting for the current financial year?
So our sense was that as compared to the 8-9% growth in credit for the system last year, this year we should see double-digit growth. Our estimate was about 10 to 12% for the year. And the stance of the bank has been that we would want to grow as per industry or faster, while also trying to improve our margins. I think that's how we really continue to look at that. We expect industry to grow between 10 to 12%, and we believe we have the potential to grow a bit faster than that.
Right. Coming to deposits now, Bank of Baroda's deposit growth in the first quarter was, I think, 10.9%, mirroring the industry trend that deposit growth is lagging the credit growth. Bank of Baroda has recently launched a new deposit scheme, Tiranga deposit scheme, offering 6% deposits. Do you see there are scope to increase the deposit rates further, or you see the deposit rates have peaked?
So I think first in terms of growth, I think it is quite natural that when the economy is relatively slow, you will find deposit growth runs ahead of advances growth. And when the economy improves, the advances growth will pick up. And for some time, it might be faster than deposit growth. So I think that's something which is part of a normal cycle. In coming to rates again, I think there is no doubt about the fact that we were because of the liquidity surplus situation, we were in a situation where rates were actually in real terms negative. That is not something which can or should continue indefinitely. So there will be a correction that will happen and rates will go up. they have begun to go up, and I think there may be still some scope for rates to increase as we go along. And I think that is something which is healthy for the economy, healthy for the banking system, because at the end of the day, if banks want to attract depositors to place deposits with the bank, I think giving an inflation-adjusted return which is positive is important.
Coming to treasury operations, sir. Now, most of the banks, including Bank of Baroda, has taken MTM losses in the first quarter because yields are rising. And if you see the RBI minutes of the monetary policy, there are indications that interest rate could go further. So, what is really your strategy to manage the yields, the treasury operations going ahead?
So you always, again, try to make sure that the duration of the portfolio, particularly the AFS portfolio, is low, so that the impact is something which can be contained. What we saw, of course, in the last 3 or 4 months was that the rates went up by significantly higher margin as compared to what we might have expected. Everybody was expecting that rates would normalize, but the expectation was that the normalization might be over an extended period of time, say 12 months. But as it happened, the increase actually happened in a very short period. And what we have seen is there has been, again, a little bit of pullback after that. But since there was a very sharp increase, which was concentrated in one particular quarter, there was an impact on mark to market. But again, I would say we should not, again, get overly exercised about that. It is part of a normal interest rate cycle that when rates normalize, you will benefit in terms of yield on loans. But conversely, there will be a mark to market impact on your investment portfolio.
I was coming to that, sir. Despite MTM losses, Bank of Baroda reported healthy profit growth, mainly because of lower provisions and improvement on the back of improvement in asset quality. However, the restructured pool remained elevated at 2.5% of the total loans. Is there a concern that some of those restructured loans could turn to NPA and worsen the asset quality?
So I think there are two figures that you might want to look at, or three figures you might want to look at together. One is the restructured pool that you have talked about. Then there is the SMA book, which is there. Now, the SMA book of the bank actually has come down from about 2.5% to less than 0.5%. So that would seem to indicate that there is no stress which is building up in the balance sheet, and we are on the path of recovery. The third figure that, again, is relevant in this context is the net NPA figure, which for Bank of Baroda has now come down to 1.5%, which means that your existing stock of NPAs is very well provided. So I think, and the fourth figure, again, which you might want to look at would be, again, the slippages and the credit costs, which again have shown a consistent downtrend. So to my mind, the upside that we have seen in terms of lower provisioning, lower credit costs is likely to continue because there's been a secular improvement in the corporate credit cycle that has happened over the last few quarters. And if there are still some vulnerabilities, for instance, it is a fact that the MSME book is something which can still have a bit of a downside. But given the fact that the corporate book is 50% of loans, and that is something which is of very good quality now, well seasoned, well proven, I think overall credit costs should continue to come down, and that should have a positive impact on the profitability of banks.
Right. So, I mean, the gross NPA ratio and the net NPA ratio is also a function of the credit growth, which is going to be healthy. So, where do you see your gross NPA and net NPA by the end of the current financial year?
So, look, the gross NPA is a figure which, again, gets impacted by a number of factors, as you said, by top line growth, also by some write-offs, which you have the capacity to do. Net NPAs is important, again, because that really is the downside that you still have on your balance sheet. That is now down to 1.5% for us. And I think that should come down further. And that, to my mind, gives a lot of comfort to us in terms of how we are positioned as a bank.
So you expect net NPA to fall below 1%?
I hope, again, that the improvement that we have seen over the last few quarters continues the next few quarters also.
Coming to net interest margins, sir. Your margins contracted Q1Q basis to 3.02%, mainly due to higher growth in the low margin overseas book. Do you expect the overseas book to continue to grow at a healthy pace? And what is your guidance on the margins?
So I think the margin impact was as much on account of the fact that in the last quarter of the last year, there were some recoveries which were there, which actually went to the interest line. Adjusted for that, margins actually had been fairly stable. You're right that the overseas book has grown by nearly 30% YOY, yes, and that has some impact on margins. But our guidance still is that we believe that we should get about a 10 basis point improvement in margins during the year. So our sense is that the overseas book can still grow. And just to again put it in context, that why did we see this kind of growth? So last year, what had happened was that because of the high liquidity in the banking system, the spreads on highly rated domestic corporates had contracted very significantly. So it made sense to pursue some growth opportunities internationally where you were getting better spreads. So as again interest rates normalize in India, a larger proportion of growth will come from the domestic market, and that should also have a positive impact on margins.
On the other hand, sir, since fixed deposit rates are increasing, CASA could come under pressure. The CASA growth may not be there as much as you wanted. Isn't that a negative for the margins?
So I think to some extent you're right, but I think what we were able to do was to utilize the opportunity over the last 2 or 3 years to significantly improve the CASA proportion on a balance sheet. So when the bank actually amalgamated on 1st of April 2019, the CASA ratio of the bank was 37%. Today it stands at 44%, which is fairly decent. So which would mean that as the interest rate cycle changes, as deposit rates go up, the proportion that is going to get repriced will be relatively smaller as compared to what it would have been if the CASA base was lower. And I still believe that there is still scope for CASA to actually again grow a little faster than term deposits this year also.
On that note, sir, thank you very much for speaking to us. And it was a pleasure talking to you.
Thank you, Manojit.
Thank you, sir. Thank you so much.
Chadha says growth is expected to be better compared to last year. The contribution of banking system to growth and financing should be more compared to last year as well. On the other side of the spectrum, one issue that has been garnering attention is that of merchant discount rate. As regulators decide on whether MDR is necessary or not in UPI transactions, we need to understand what the merchant discount rate is.
When you swipe your debit or credit card, the transaction has a cost. This cost is charged from the merchants for enabling these transactions at their outlets. It is known as merchant discount rate, or in short, MDR. It is the pricing structure that determines what each entity in the payment services loop gets when a transaction is completed. Take the example of RuPay credit cards linked to the Unified Payments Interface, or UPI. In the case of these transactions, the MDR is set at 2% of the transaction size. If the transaction is valued at Rs100, the MDR would be Rs2. Out of the 2%, 1.5% is the interchange given to the card issuing bank, while the remaining 0.5% is shared as fees between RuPay and the acquiring entities that facilitated this transaction. These could be banks or non-banks like M-Swipe Technologies or Paytm. The Reserve Bank of India's recent discussion paper on revisiting charges across payment modes has put MDR in the spotlight. The paper argues that charges should be reasonable and determined by market forces for users, even as it is optimal for intermediaries to earn enough to sustain operations. This is critical to attracting fresh investments in the payments industry. But will smaller merchants agree to pay MDR? That is a crucial question. Don't forget that UPI is a toll-free highway. The huge spurt in UPI transactions masks the problem of a good percentage of them being declined because the system can't take the load. Plus, there is the elephant in the room. Should there be zero MDR on RuPay debit cards UPI on transactions of ticket size up to Rs 2000? This move was introduced in the Union Budget of July 2019. The aim was to lower the cost of acceptance for merchants and thus incentivize them to accept digital payment instruments instead of cash. The flip side is that entities which enable these transactions get to earn nothing from them. For now, the Union Ministry of Finance has said there is no proposal to introduce MDR on UPI transactions. But will they continue to be free for all times to come?
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
While there is a tussle about the MDR issue, digital lending is also facing questions, especially over practices by certain errant apps. RBI recently issued a draft of digital lending rules. Our consulting editor Kamal Bandyopadhyay explains the ground realities of India's P2P lending model, its failures, and his take on MDR. Hi Tamal, thanks for coming on the show again.
Thank you.
Now, this week's column was interesting because it covers a part of the digital economy. And the part that it covers, you talk about, is the P2P lending space in India and how some actors have been taking advantage of it. Can you explain in simple terms what these are and how it works?
Well, it's a P2P lending. It's just offering a platform where you and me, I have money to lend and you want to borrow. So instead of going to a bank or non-banking finance company, you come to this platform. And the P2P company is a matchmaker. Its responsibility is to see your credit score, whether it's worth giving, and accordingly the interest rate is fixed. It could be as high as 18 to 20% or as low as 10 to 12%. Particularly the MSME segment can get benefit out of it. It's basically a matchmaker, matchmaking platform. And of course, there are rules how much you can lend to one particular person, overall how much one can lend, and similarly how much one can borrow. So this is an alternate channel. Reserve Bank of India, of course, gone deep into it and framed the guidelines, even though it has not taken off in a big way. But there are 25 odd licenses. At least 2 of them have surrendered, I understand. At least one of them is not doing business anymore. So it's not a great success story as such. But the column is all about, as you said, it's about how some of the players are misusing and they don't care about the notes.
What you also highlight in your column is that what is happening in India is not actually P2P lending, because you highlight a pooling of money. Can you explain what that is exactly?
Exactly, Ishan, that's what I said. Ishan and Tamal, Ishan is, let me make you a lender. Ishan is a lender and Tamal is a borrower, and P2P platform gives the matching ground. But what's happening here is this: no, some of the P2P players are asking Ishan to give the money, and Ishan can get out of any time Ishan wants, even 5 or 6 days. Ishan will get certain interest. So their interest is offered for different maturities. Up to, that's the catch here, because Reserve Bank of India does not allow you to offer any guaranteed returns. So they are escaping. They are meeting the not the spirit but the letter, saying up to X% you can. So essentially, what is happening? Ishan does not know where his money is going. Ishan's money is, and along with XYZ, a pool is created, and it's more like in mutual fund what you call a liquid fund, which invest in short-term instruments up to 90 days. So here you can get out at any time and get your money out plus the interest. So that's one misuse. Second is offering certain percentage, up to certain percentage. It's working like as a bank FD. So instead of keeping a bank, you keep it with me. And third is, of course, there are certain entities who are renting out the platform to others who do not have the license to do the P2P. So what's happening is, certain players, I will not name them, they have access to data for individual credit cards, debit cards, as well as merchants. So they know who wants money and who has money, and they are passing on the data to this particular P2P platform, and there the transactions are taking place. So in a sense, certain P2P players are renting out their licenses to unlicensed players. So in multiple ways, I mean, what it is it a liquid fund? Is it a collective investment scheme? Is it a bank FD? What is happening?
Now, I get your point. Now, one question was, how far do RBI's digital lending rules go in addressing some of these issues now?
Yeah, the latest norm that Reserve Bank of India has come out does address some of them. I would like to believe the Reserve Bank of India is well aware of what's happening in the P2P. Now, instead of addressing P2P per se in that particular sector, it has come out with the normal, omnibus norms, which will, to some extent, address certain issues, certain concerns, what's happening in P2P. Because the key to Reserve Bank of India new norm is this: at least in one leg has to be a regulated entity. So that will address many of the malpractices or the violation of rules, not only in P2P, even in other segments happening, and the frauds that's happening.
One question that has been troubling me is RBI the appropriate regulator here, or do we need a specialized regulator with rules being set by the central bank? Given some other countries have done this model.
Exactly, this is what the evolving scenario. Is the Bank of India competent enough? That's what people are questioning. I think the jury is still out. Reserve Bank of India, it's trying its best to equip itself. Now, whether you need a separate regulator, in one way of saying it, why not? And other way of saying it, because it's a part of the financial system, Reserve Bank of India can continue to. In fact, if you see the globally, there are a lot of, if you compare Indian central bank with the global central bank, there are the Indian central bank is a multitasker. Lots of things which it does, which globally the central banks do not do. After, of course, constitution of MPC under the new norm, it's now a flexible inflation targeter central bank. Should it hive off its role from managing the digital world? That's the question I think Reserve Bank of India needs to ask itself. But even if that happens, it can't happen overnight.
Because we are discussing digital transactions, I would like to take into the other part of digital transactions, which is UPI and the issue of MDR. Now, RBI recently came out with a discussion paper and it's open to public opinion. On that, it discussed the MDR issue, the convenience fee and surcharges issue, but the government came out immediately and said that UPI is a digital good. What do you make of the whole issue?
It's pretty clear that government and RBI are not on the same page. If you see Reserve Bank of India's entire discussion paper, which has raised 40 questions, very non-committal. It's leaving everything to us and asking for feedback. And the deadline for giving the feedback was 3rd October. But the government of India did not lose any time. It's immediately issued. There are 2 tweets essentially saying that it's for the growth of digital world. It should not, UPI should not be subject to MDR. MDR is the merchant discount rate. Subsidy Raj that has happened in different segments. That's prevalent here now also. But the kind of money which the banks have been given as a compensation for this is certainly not enough.
Now, because you've talked about public sector banks, one of the papers in RBI's bulletins by RBI researchers, which RBI had to give a clarification on later, talked about the gradual approach to privatization and not a big bang approach. They also talked about how the social objectives also need to be kept in mind. What do you make of that approach?
No, I guess it's more a media made because Reserve Bank of India's approach is not different from what the government of India's approach is. Because 2021 February, Finance Minister announced privatization of 2 banks, and it's not yet happened. The process is still on. The amendment to the act has not yet happened. So the government itself believes in a gradual approach. So there's nothing new about Reserve Bank of India, what RBI had said. It will be a gradual approach. I think it will start with. So probably the way forward is this. Yes, you experiment with 2, and then you grow the numbers. Right now we have 12 public sector banks. Probably you go to up to 6 or 8, but you leave 4 or half a dozen for the social purpose. They'll be owned by the government, but don't expect them to be a profitable organization.
Got your point. Thank you. Thanks a lot for coming on the show. Until next time, thank you again.
Thanks, Dishan.
Kamal believes players are misusing the P2P lending space and not following the norms. As for merchant discount rate, he points out that the subsidy Raj has permeated the space as well. Last week, we asked you a question about the digital lending rules. We thank you for your response. Around 60% of the people in our poll believe that the government has not done enough to curb the menace of digital lending apps. In light of the current discourse, we want to know from you if banks should charge a minimal fee on UPI transactions. Our polls will open on Friday and you can respond on Twitter, LinkedIn, Instagram and our website. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.